we're in a place where we have, which is a computational innovation in recent years. The marginal cost of assembling these big data sets is very small, so it's convenient. But at some level, the underpinnings, the underlying logic is flawed.
Yes.
And so the foundation crashes upon what you might call the maintained hypothesis, nothing that can be tested. And yet, in reading your book, the texture of knowledge and information, as you said in your opening remark, on a case-by-case basis, is lost by taking this 40,000-foot statistical view and I guess assuming that diversification can mask any inadequacies of lost particular information.
And then whenever things go wrong, people don't question diversification itself as having been the problem, but they sort of say, well, they didn't diversify properly. I mean, they used the wrong model for diversification. If only they had had the right model for diversification. And of course people should diversify. But diversification is a second line of defense, not a first line of defense. So a venture capitalist, any sensible venture capitalist, will not put the entire venture capital portfolio into one startup. They will have 20 investments. But they will not look at the variance-covariance matrix of the expected returns of these 20 investments. What they will primarily look at is what is the risk and return of each investment they make, and if that is done in a sensible way, then they will expect that the long-run result will be a good result.
Yeah, sometimes they will have drawn a false inference, but they're protected through the diversification.
Exactly.
But each one is treated as though it doesn't need to have covariance properties.
Exactly.
And when you see the entire industry unable to close a fund because they can't raise money, you imagine that the correlation matrix probably changed pretty substantially because people are going to starve for cash.
Absolutely, and the same is true of banking. I mean, it makes perfect sense not to have more than X% of your portfolio, of your loan portfolio, be with one credit or with one industry. But it makes no sense to assume that if I diversify my loan portfolio, I can do without the actual case-by-case analysis. And there's yet another pervasive flaw and convenient flaw which we see in the justification of this modern financial approach. It is claimed that the transaction costs of extending credit has been reduced by replacing judgment with mechanistic models. And therein lies a deep misunderstanding of what a transaction cost is. It is certainly true that if you replace a loan officer with a model, the actual cost of making that loan will go down. But what these models fail to take into account is that the real transaction cost of a loan is not the actual cost of the loan officer. The real cost is the loan loss that will frequently be. So to say sort of, gee, you know, we can now extend $50 billion of consumer credit simply by looking at a set of numbers, and it's much cheaper than it used to be. That's completely wrong, because that doesn't take into account the fact what has happened in the long run to your to credit losses.